Hello, and welcome back to the Keeping It Real Estate podcast with Chris Bober. Of course, I am your host, Chris Bober, with Team Bober at Nebraska Realty. Together, my wife and I form Team Bober, where our mission is to build relationships by providing a positive real estate experience to exceed our clients' expectation. And our purpose is to educate and empower our clients to make great decisions, to serve with authentic hospitality, and to provide client-first representation. So before we get started, just as a reminder, if you're watching this on YouTube, right down there's a little button where you can subscribe to our channel. That would really help us get our message out. You can also click the bell for notifications, and wherever you're seeing this on social media, there's going to be a link down below to get to our website, to our guest website, and information about what we do and about the marketplace. And of course, if you're listening to this on a podcast, click the subscribe button so you get notified when we have new episodes come out. So today we brought in a guest, right? So this month we've been talking about, how to purchase a home. And we introduced our VIP buyer program, where we have steps to ensure that buyers have a great experience. But I thought I'd bring in an expert today. So I'm joined today by Justin Pinkerton of Arbor Bank. And Justin, thanks for coming on today, buddy.
Hey, thanks for having me, Chris. Very excited about this. I've watched your podcast a number of times. So, hey, I'm excited to be here.
Awesome. And then Justin, of course, with Arbor Bank, is a partner of Nebraska Realty. So you come by our building. Arbor Bank is up on the side of the building. So they have a great relationship. And of course, Justin and some of his people are in our office. So we have access to them so often for any questions. And of course, we've done several deals with Justin. He's one of the best out there. We love working with him. Okay, Justin. So what I wanted to ask you first was, from the real estate perspective, we see a lot of different reasons for what's going on in our market. And I think that between the beginning of last year to the beginning of this year, we had a pretty significant shift that's continuing to happen in our marketplace.
Yep.
And we're kind of being held back by inventory. Those are things we can't control. But the shift is also kind of coming based upon a huge factor, especially for buyers, and that's the mortgage rates. Right. Last year, at the beginning of 2022, we were down around 3%. And within a very short period, it pretty much doubled, and it's actually more than double. And it kind of fluctuates a little bit here in 23. Tell me about how that's affected you guys on the mortgage side, and why you see some of those big changes in there. And then, of course, next we'll talk about what's going to happen going forward. So the doubling of mortgage rates, tell me how that affected your business and why it happened.
Yeah. So from an industry standpoint, when you relate it to the consumer, it's really affected affordability at the end of the day. So three primary areas that we talk on, educate on, and that consumers are most concerned with: monthly payment, total cash out of pocket or down payment, and then time frame of ownership. And that first piece, the monthly payment, that's had a massive impact. Mm-hmm. This last year, 2022, was the highest and fastest increase in rates ever recorded in history. So it's not only was it an increase, but the pace at which rates increased was unfathomable. So yeah, we've seen a hard crunch. And a lot of what I'm seeing or feeling, or just even looking back and reflecting on this last year, is that more than anything, it's the time that consumers have been allowed to realize where rates are. So it's a lot of re-education, a lot of different types of conversations. 3, 4, or 5 years prior to that, rates had been really at all-time lows, historic lows at a couple different points. And rate really wasn't much of the question, because rates were great in the media's eyes or in consumers' eyes. So when they rose this fast, consumers really didn't have time to adapt to where rates were. And in some cases, it was a massive surprise from 1 month to 2 months later. So that's been the biggest piece. A lot of re-education, a lot of different types of conversations that need to be had.
Yeah, from our perspective, I think we saw the first half of 22 go from 3 to 6 really fast. And there's this kind of pivot point in about June, I think, when it really kind of escalated. And I always related to people, like, if you're buying a $200,000 house and the interest rate goes up 3%, well, that's $6,000 more a year you're paying in interest. That's $500 more a month. And what I saw happen is it took a lot of people who were qualified for a certain amount, and it took them and it basically took them down a price point
Yep.
because that payment has gone up. Now, maybe you can explain this in just a short, brief explanation, but for people to get qualified for a mortgage, you basically there's several factors, but one of the big factors is their debt to income ratio, right? You can
Yep.
only allow a certain amount of your monthly income towards debt, and a certain amount of it can only go towards your mortgage, and that bump people out, right? So give us a quick little explanation of kind of how the mortgage world works when it comes to that debt to income ratio.
Yeah. So from a qualification perspective, there are some industry standards that the mortgage industry applies the debt to income ratios to. So typically, on average, they want to see that that mortgage payment that includes taxes, homeowners insurance, and mortgage insurance somewhere at or under 28%. That's
Mhm.
kind of a rule of thumb. It's not a hard and fast rule, but that's kind of the rule of thumb. So gross monthly income times 28%, that's roughly where you want to be.
Mhm.
From a total debt to income, so adding other debts such as auto loans, minimum payments on student loans or credit cards, plus that mortgage, they want to see that at or under 43 to 45%. And again, that's not a hard and fast rule. There's a lot more that goes into it, some computer modeled decisioning that at the end of the day is the ultimate decision maker. But that's kind of just a rule of thumb and some guidance that we follow. More past that, it's from a mortgage consultant standpoint, it's really more about, I call it the affordability factor. So
Mhm.
just because someone might qualify for, say, 28% of their gross monthly income doesn't necessarily mean that they want that amount of monthly mortgage liability. So really for us, it's more about the goal planning piece and talking about what that specific consumer's goals are in relating to housing. So we try to set those parameters with the customer right up front, what their goals are. Sometimes they're surprised on one end and or the other. Maybe they qualify for more than what they want to afford on a monthly basis. And sometimes it's the other way around, that they don't qualify for quite as much as they're maybe willing to afford out of their monthly budget as well.
Yeah, and
So
that's why it's so great to partner with people like Justin. When it comes to the financing side, as realtors, we have a general knowledge, but then we will send our people to people like Justin, and they'll have that conversation, right? Because you can go online and put in there just your numbers, and it'll tell you, hey, you can afford X amount. But that doesn't tell the whole story, right? Sometimes
you're
there's
spot on.
extenuating circumstances, or maybe they want to save up for something. I know student loans have been a big deal, whether they count, what they don't count, whether they're forgiven. But these rules are put in place. There's a good reason behind it, right? And that's why we feel so strong about the market going forward, because I know you were around back in the day, and I wasn't on the real estate side, but I was experiencing when the recession came,
Yep.
right? And what was happening then was those ratios were out of whack, right? And that people were not putting money down, and that's what caused that big crash. And that's not where we are today, right? You feel much better about it, because I think the restrictions on buying a home have gotten even tougher, and banks are the ones that are being held accountable. The lenders are. So those things are in place for a really good reason. And of course, it just doesn't come down to just put numbers into a formula. It comes down to say, okay, this is what the estimation is. And oh, by the way, you're also going to have to pay interest, and you're going to have to pay taxes, and you're going to have to pay insurance every month. So you got to count those estimates
Yep.
too. So there's a lot that goes into it, and that's why we rely on such great people out there to do that. Now, going forward, I've heard a lot of different projections out there, but I think the consensus, what I've heard from some of the best people like Dr. Lawrence Yun, the chief economist for the National Association of Realtors, they feel confident that we're pretty much towards the top for the time being. I mean, we have small fluctuations. A couple weeks ago, it went up,
Yep.
a 0.5% right away due to
Pretty
a
quick.
jobs market thing that came out. But we feel like we're hovering, and then we might actually start seeing a decline coming up. This year a little bit, but I think even next year they're talking about it going down to where we're talking maybe in the fives, even maybe below that. Tell me, from your end, I know you don't want to promise anything, and we're not going to hold you to it, but
Yep.
tell us how that plays in, and maybe educate us a little bit on how mortgage rates are determined as they go forward, and what to expect.
So we follow a number of individuals that give market guidance on a day-to-day basis. It's something we're very, very closely in tune with. Some of the projections, even economists that, like Mr. Yoon, or might even be Mortgage Bankers Association, some of those are projecting that towards fourth quarter of this year, first quarter of 2024, that, we could see rates that maybe have a 5 in front of it. So some relief maybe on the horizon. We did see rates pop closer to almost 7% this last week, or even yet this week. Even some of that was worldwide news. So inflation concerns overseas in Europe actually affected our markets here in trading in the U.S. So it's not just our own economics here within the United States. It's really worldwide. A lot of geopolitical information that can drive our markets here too. So we do feel that there will be some relief. How much and when, still TBD on that part. But from a market standpoint, that brings a really good question. We have a lot of consumers over the years that get tied into, and a lot of this is through the media, that we get tied into, the Fed, they're going to raise rates again, so my mortgage rates are going to go up. And it can be a good indicator of where the economy is, or the health of the economy and the direction it's heading, but it's not necessarily a direct driver of mortgage rates. So mortgage rates are driven by what are called mortgage-backed securities. They're a form of a bond that are traded on the stock exchange, New York Stock Exchange, open market. And that's technically what drives mortgage rates. So we're more really in tune with what the 10-year Treasury rate is from a direction standpoint versus the Fed overnight lending rate that we hear all the talk about, the Fed meetings, and where rates are going there. So we're really in, Chris, what I would or have classified, what the market would classify as a more of a reactionary trading market. We're really reacting to the health of the economy. Inflation's a big key factor right now. Whether the U.S. has this big, massive issue of inflation under control yet. As we start to see that tame, we'll see some relief in rates. But that's the key question right now. And within that, all economic drivers, whether it's unemployment or manufacturing or cost of goods, they're keying in on all of those reports on a day-to-day and week-to-week basis and reacting to those trades. So a lot of different factors that aren't typically present in a normal market or average market that are at play today.
Yeah, and some of the stuff I've heard talk, we don't know if there's going to be another COVID incident come up. We don't know if there's going to be another war like Ukraine, and those things affect, the perception of things and drive those too. But I also know, I think I read somewhere that the difference between the mortgage rates and the bond yield is as big as it's ever been. And that's built in to kind of buffer what could happen. But as if we can get a long enough period where inflation starts to get under control and positive stuff comes out, then the lenders are going to feel comfortable closing that gap a little bit. And I think that's what their confidence in is in saying that's going to be a little lower, right?
Yeah, absolutely. Yep. Your direction on that is spot on, Chris.
Yep. So they build it in now. But what we're seeing, and we talked about this a little bit earlier today in your office. We have, since last year, we're getting, I think, a different segment of people buying homes, right? I think a lot of the first-time home buyers that were sitting on the sidelines because of all the uncertainty, they want to be homeowners. And the good thing about them is they don't know 3% interest rates because they weren't in the market for a home then. So 6 to 7% to them is just normal. And they're coming out in force. We're really, really hoping for some inventory to sell to them. It'll level off our market a little bit, make it a little less volatile. But is that kind of what you're seeing? A lot of first-time home buyers out there. And then for those first-time home buyers, there's a couple of things that we kind of share with them as we try to instill confidence in them is, you can marry the house and date the rate because, refinancing, there is a cost to that, we know, but if it gets good enough, you can always come in at a lower rate. Also, I know that there's different products available than just, need to have 20% down to go get a conventional loan. So what are you telling your buyers as they come into you when they have concerns about these rates and where it's going to go and stuff like that? And what are some of the solutions you guys have for them?
One of your first comments, what we're seeing a lot of first-time home buyers still entering the market. We have new individuals each year. They're graduating college, graduating high school, entering the workforce, and they're looking for housing. They need housing, and we're still seeing a big demand from the first-time home buyer market. And there are a lot of options that are out there. So it really all boils down to that individual customer's goal plan, what they're looking for, down payment wise, monthly payment wise. And I think the third piece that is the third most important part is really talking about that time frame of ownership of what that specific customer's goals are. So how long do they maybe plan to be in this next house? How do they want to use it today? And how do they want to use it long term or midterm? And really trying to customize options that fit within those goals. So I think the big part with that is talk to a mortgage professional, talk to a real estate professional, ask about the questions. Are there some first-time home buyer products that are available that help meet your goals? Because there are some things that are available right now. Typically this time of year, we've got some first-time home buyer grants that become available. There are some first-time home buyer programs through Fannie Mae and Freddie Mac, the Nebraska Investment Finance Authority available as well. So there are options. It's really just getting educated and being open to take that first step in the process. I do think the second part that you made the comment of, that the reason we're still seeing a lot of the first-time home buyers more willing to enter this market is that exact statement that you made, that they didn't know rates at any other point, and they're not focused on buying on rate. And I think if the consumer can really shift their mindset from not buying on rate, but buying based upon what the current market will afford them and whether or not that fits in their budget and their needs, that's really where the customer needs to get to. And right now, first-time home buyers, they don't know any different. So it's a matter of, they know that real estate's a good investment. It's going to satisfy a need, which is housing. And the want there is the hopeful appreciation on that appreciating asset being the collateral, the house. So I think that we're going to continue to see that heat up. And as more and more consumers get used to the rate market that we're in, I think the more that we'll continue to see enter the market. But for right now, it's pretty easy to make that first step for first-time home buyers.
Yeah, and I think that's what's happened. I think it took, from like the middle of last year to the end of last year for people to kind of have their short-term memory kind of cleansed, to realize that we're going to stay up here, and let's just leave those 3% rates back in the past. And I also know that, you don't get to experience the benefits of the American dream of home ownership until you actually own a home, right?
That's right.
I mean, there's nothing better than taking something that you don't have to own completely and getting to keep the appreciation on it. Right. I mean, you're paying a service, like you're given a mortgage to basically rent your house until you own it. But whatever appreciates that, you get to keep. Right. And that's a pretty cool thing. And the government protects you on those gains and stuff like that. And I think that, I've heard people say, well, I'm going to wait till the prices go down. Well, I don't anticipate prices going down on houses, because pricing is determined on supply and demand. And we are way behind on supply and way saturated with demand. So you got to jump in. If you're looking to own a home, you got to jump into it at the current market conditions and then start experiencing those benefits. And, yes, could it be better? Could you have 3% interest? Yeah. But maybe if those rates were still down there, your home's going to pay more, right? If you want to wait till next year when it goes down, well, you're probably going to end up spending more money because the price of the house is going to go up, right? House season continues to appreciate as it goes. Do you agree with that?
You and I have talked about this a number of times. I'm a big believer in that. We're not buying at yesterday's rates and yesterday's market prices. If that was the case, there's a lot of houses I'd like to buy at 4 years ago market prices and where rates were, right? But no, we really need to approach it from this standpoint of what's that customer's goals. And if this is if they're going to plan to be in this house 1 to 2 years, well, then we probably need to be a little bit more careful of where and how they're buying that piece of property. But if this is more of an investment that also satisfies that housing need, then really we want to step back and look at the big picture of, I'm really investing in a piece of real estate that I'm using to satisfy my housing need as well. And taking advantage of appreciation and starting to build that wealth through housing. And so we really want to focus on what can we buy today at today's interest rates and today's market prices. And If it gets us into a price range that works, that satisfies either a want or a need, then fantastic. We're in the market. And if it doesn't, at least we know when we're well educated, and we need to figure out a path that we need to be on, because at the end of the day, we buy on monthly payment, we buy on down payment, and whether or not we need a house or want a house. Maybe it's an investment property, maybe it's a second home. So focusing on the market that we're in from financing and also market price, that's the way to do it.
Yeah, I love it. I just see every market that's coming, we try to stay ahead of it, not because we want to be prognosticators or predictors of what's going to happen in the future, but it's to see the opportunities that are out there. And we still live in a great time, right? It's still affordable to buy a house. It's harder, I get it, but people are making more money, houses are appreciating. So there's so many benefits of that. And that's what's great about these buyers that are coming into the market now. Like, they're not tripping over what's happened in the past because they don't have a past history of home ownership. So
You're
it's
right.
still a dream for them. And, it's guys like Justin and I that try to get them to that American dream of home ownership. But so this is all great, Justin. I really appreciate it. So we're going to kind of wrap it up here. I know you and I could talk about this stuff all day,
We
but
could.
people will get bored and they'll turn us off. But, for you, those of you guys that are out there listening and watching this, just don't believe the narrative that the media puts out. And I'm not anti-media or anything like that, but go to a professional to get your information, right? Not a website, anything like that. In the caption down below, I'm going to include obviously my information. I'm going to include Justin's information. And he's a true professional that truly cares about getting his customers the best opportunities. And then of course he partners with people like us and we help them find that home and take them through that process. But Justin, thanks so much for coming on today. I really appreciate you doing it. Quick reminder for everyone who's listening, I'll give you another reminder. If you're listening to this podcast, subscribe to our channel because we put out tons of great information. I mean, when you got people like Justin, you definitely boost the credibility of our brand. Of course, YouTube, click down there, right? It's the other way. There's a button down there to subscribe and get notifications. And in all the social channels, our handle is @TeamBober. And, just send us your questions, right? If you know anyone's looking for more information, again, we're here to educate people and empower them to make great decisions. And we want to serve them authentically and represent them in the best that we can. So Justin, thanks again for coming on here. I really appreciate the information you shared today. I appreciate how much you've helped our clients. Justin's just one of the best out there, does a great job. So thanks for coming on with us today.
I enjoyed it a lot, Chris. You and Jen and Team Bober are absolutely fantastic. Any real estate needs that you do have, reach out to either one of them. They're great. And I enjoyed this. We need to do this again.
Yeah. Maybe we need to make this more of a regular thing as things come up. So let's sit down and have a beer or a cup of coffee and figure out something to keep doing this. But again, we're gonna sign off here. Justin, thanks so much. Go to teambober.com for information about everything we do, and we'll have links to everything Justin does in the captions below. So Justin, have a great day. We'll talk to you next time.
Thanks, Chris.